is that rates have been moving higher. 4.11, 4.12 on the 10-year. Stocks are shaking it off. The high-tech stocks in particular. The S&P's up 0.5%. The Dow's up 85. What does Market Navigator hold?
It doesn't seem like it's recessionary, right? A rising rate market and a rising stock market?
At all.
All right, so Kelly, as this Fed navigates the rate strategy, questions are continuing to pop up about the likelihood of a recession. But the bond market is signaling recession is just not in the cards anytime soon. So our next guest says that, in fact, upside opportunities actually exist around the fixed income markets right now. We're speaking with Joanna Gallegos, the co-founder and chief operating officer over at ETF firm BondBloxx. She joins us here now. Joanna, this is amazing to talk about because it was just 2 years ago, maybe even less, where there was the economist consensus that we were 100% destined for a recession, a downturn, and it never happened. And now things are looking pretty good, and the bond market's validating that, is it not?
Absolutely. I think what the Fed has been able to do, and we've seen, meeting by meeting, quarter by quarter, is that they have been able to get inflation under control while supporting the economy. And so we're telling investors they really need to be leaning into the continued resilience of the U.S. economy. Earnings are good. Balance sheets are strong, and the American economy is doing well. So that means that there's opportunities, especially at this point when we're in a declining rate environment, in fixed income and the income of your portfolio.
So we talk oftentimes, Kelly, about the Treasury market, the rate side of things, and that's the benchmark. It's the safety and security of the full faith and credit of the U.S. government and the U.S. taxpayer, you and I and everybody else. But it is in corporates and not just investment grade, but also high yield, those so-called junk bonds that are actually showing some attractiveness to you. Tell us why that is.
Yeah, so we see there's a lot of valuable income potential in credit. That is the debt of corporations. And our strongest view is actually in high yield. So the reason for that is that, as I mentioned before, balance sheets are very strong right now. And most investors really haven't looked under the hood of what's going on in these corporations. Their interest rate coverage ratios, which is their ability to pay their debt, are high and good and stable. And so that means you can look at these credits, look at these corporations. High yield is a great place. It's yielding, between 7 and 6%. And on the CCC side, which is sort of the lower credit rating and high yield, over 11% in yields. And that's an amazing place to search out more income for your portfolio without some of the distressed risk that everybody's been looking for. Like you mentioned, we still believe in a soft landing or if a no landing here at BondBloxx. And so we're highlighting that this is a place of great income and potential return in a declining rate environment.
And obviously, if the economy looks better at the margin, Joanna, that would be more supportive for kind of dipping your toe into high yield. My question would be back what you said earlier, and for the landscape in general, are we in a declining rate environment? We've seen the 10-year back up 50 basis points since the Fed cut, so maybe we're looking at more the 5-year portion of the market. But are investors potentially able to get better yields if they hold off, if there's the potential for rates to even move higher?
Well, I think what we need to just do is listen to the Fed is that they're going meeting by meeting, data point by data point. I think that served them well. They made a bold cut in September of 50 basis points. They've indicated that they are looking to decline, to reduce rates going forward. And so I think that if you're looking for possibly, the rates to hold or to go up, that's just not what we're hearing from the Fed. And I think if you look at the history of the way earnings have come in quarter after quarter and rates and people have been able to endure these higher rates, there's probably a reason that they're going to keep going down. So we wouldn't say that that's a significant fear for us. We are in the soft landing, no landing, lean into these really good fundamentals of the U.S. economy and take advantage of these opportunities in corporate credit.
All right, corporate credit, that's the idea. We're looking at some of these charts right now. But Joanna, what part of the spectrum of the yield curve are we looking at for these corporates? The very short end, the very long end, that's what we focus on. Are they the opportunities or somewhere in between?
Yes, probably somewhere in between. We have an opportunity in investment grade credit in triple Bs. That's sort of the area of investment grade that has the highest potential for total return and yield. And we're recommending the intermediate space in investment grade. So most for that and for our rates recommendation, we're saying, get out of that ultra short space on the rate side and the treasury products, but also as you're taking credit, our strongest recommendation in investment grade is in the intermediate space.